Welcome back to the Dividend Diplomats YouTube channel, everyone. Who is it? Lanny and Bert, the Dividend Diplomats. Everybody, get ready, get hyped up. We have not one, but two undervalued dividend stocks to keep an eye on and even buy over the next couple of weeks.
Guys, smash that subscribe button. Give your boys a nice thumbs up on the video. I know the stock market has really hit the fan this week. We had a bit of a green day, on the last, day of the week, Friday the 17th, but overall, S&P 500 is down again, 165 points or 4.25%, Beard.
I'm just laughing because it's like that end of the basketball game when they pull the starters, the team's down 25 and the bench comes in, scores 8 in a row, or team's down 10-0, you score a couple runs in the ninth, they're short in the lead, because that's what Friday felt like, because it was a bloodbath this week with the S&P 500 closing at 36.74. All the 2021 gains are out the door, Lanny. These are the prices it was closing at around at the end of November and the beginning of December of 2020.
That's what I like to hear because we're investing. We're passive income investors. We like to buy dividend stocks at lower prices. We're buying more income for less. Obviously, the other big news to hit the press this week was obviously what's going on with the crypto world with Bitcoin and Ethereum really touching down almost at 20,000 and 1,000. Celsius, putting a halt to withdrawals and stuff that's going on over there, really dominoing the crypto industry, which also catapulted into the stock market, I would say.
That's right. And that also kind of helps reinforce why we're doing what we're doing here. We're buying these long-term dividend growth stocks. We're buying the companies that have proven over time through good economic cycles and bad economic cycles that they are not only able to continue paying their dividend, but increasing it as well.
And that's exactly what we're here to talk about today, because Bert put together two stocks. One company, Bert, there was a big investor that just threw a big hammer down on owning a lot of shares. And, Bert, it's up to you if you want to jump right in and kind of hit the headlines with the first stock here.
Well, let me get my call from Warren Buffett coming here. That's right, because hey, Buffett, what did you just invest in? What's that? What's that? Oh, yeah, do you want us to talk about the stock screener first, or you want to tell them about that? We'll just put the stock screener on the bottom, Buffett, so we can just jump right into the company we invested to. So everyone look below and see what the three metrics of our stock screener are. Citibank, you're right, ticker symbol C. Thanks, Warren. We're good to go now. Lanny and I will take it from here.
Citigroup, ticker symbol C. Bert, you are looking at this dividend stock right now because, man, this stock price is down over 30%.
A beating indeed is what has happened with this stock. Lanny, my wife and I bought it, around $60 to $70 per share is when we invested in it. Came down a little bit, hung around the 50s for a while, and then the floors kind of ripped out from it. It's in the mid 40s. Good old Mr. Buffett came flying in from Omaha. He came jumping in off the top rope. That, what would you say, Lanny? More like a macho man coming in off the top rope with the flying elbow down.
You're doing a Jimmy Snuka buying some Citi here. And, Bert, I mean, these metrics look pretty wild too. So even when we go through the metrics of Citi, we're also going to talk about that price to book ratio in addition to the price to earnings. But it seems like Citigroup's doing some interesting things to their balance sheet, slimming down their, assets, right, Bert?
Yeah, they're selling off different divisions internationally that may not reflect their core banking presence. I know they've talked about Mexico selling some of that business. They've talked about other international companies really slimming down and focusing. And I think that's kind of what's interesting here for Citigroup in that sector. When you see so many headlines, so many terrible headlines about tech companies, about like fintechs, banks, neobanks, everyone just laying off employees. Citibank's kind of pivoting in the other direction. They're seeing which way the wind's blowing. They're saying we're a large bank. We have the balance sheet. We have the income. We can hire people. We can start improving our tech available. We can build it in-house to compete and take the market from the fintechs that are losing it. They're going to be hiring over 4,000 people in that tech unit to make the experience better for Citibank. So I think that's just an interesting pivot for the company, slimming down their massive global operations to focus on the core, and then they're really honing in on building the tech to get them to that next level.
And with that, when we look at that first price to, metric, the price to earnings ratio with Citi, Analysts are expecting $6.78 in earnings. So guys, they're trading at $46.52. So when you do the math, that price to earnings ratio is less than 7. And convert, I mean, that's obviously something that we don't really see too often here on this channel. But not only that, but for banks, you look at that price to book ratio, the price to book value, which is really taking the share price or the market cap over the equity, and you can really see what it's trading at. And Bert, we usually like to see somewhere around 1, maybe less than 1 if you're lucky, and I think you're pretty lucky here.
Yeah. 0.51x is Citibank's price to book ratio. I was trying to think of a funny way to say that. Yeah, it's crazy. The share price is less than half of the book value or the equity of the. I mean, it's crazy, right?
That's nuts. I mean, and we should probably check out, is this dividend safe for Citigroup? Do you feel safe with Citi's dividend? What's that payout ratio look like?
Their annual dividend is $2.04. Divide that by the 678. That's a payout ratio of 30%.
That's huge. I mean, it's a ton of room for Citi to not just pay it, but keeping, if they want to get back, as you'll see in the third metric,
Yeah.
increasing that dividend, because they've got to come back with some increases here.
Yeah, I mean, all the banks had to pause during the start of the pandemic. They had to freeze their dividends. They couldn't increase them because coming out of the financial crisis, they wanted to make sure banks are going to be well capitalized in bad times. So the Fed restricted it. A year later, banks passed those stress tests, so you could start increasing the dividends. Citibank, they passed the stress test, didn't increase the dividend, so capitalization's there. Otherwise, they wouldn't have passed the stress test, right? They just decided to not increase their dividend like a lot of the other institutions. So could be
Well,
setting up.
maybe yeah, setting up for a big show, right?
That's what's interesting with them. And I mean, when you see an investor like Buffett come flying in there, what does Buffett love more than anything else, Lanny?
Cash flow and dividends, baby.
Yeah, so I wouldn't imagine that dividend staying stagnant forever with him on their stock list or stock register. So let's look at that. The bonus metric here, dividend yield is swelling. It's 4.39%.
Wow, well above the S&P 500. A little bit less than 3 times of what you can get out there by owning the S&P 500. So yeah, definitely getting a premium with the yield. But hey, Citigroup, I mean, less than 7 PE, less than 0.51 on the price to book, 30% payout ratio. Technically, their 5-year dividend growth rate is over 30%, even with 0% increases tucked in there. Dividend yield is well over 4%. Stock has been beaten down 31% this year. I mean, definitely have it on the stock watch list. I can see why you are eyeing Citigroup, and maybe you've been buying it this week. We'll have to see on another dividend stock purchase video.
Yeah, let's move into the second stock here on our watch list.
Number
We're going to keep this.
2.
We're going to keep it at 2 this week, though. This is another company that's been pummeled year to date. We thought Citi was getting crushed at negative 26% year to date. Try 44% down year to date, or 47% over the last 52 weeks. But you know what's different about this company than Citigroup, Lanny?
What is interesting about this company?
They are a dividend king, a company that's increased its dividends for 50 plus consecutive years.
They are the king of kings. Put the crown on this dividend stock, guys, because this dividend stock, oh my gosh, they have just really, you're right. I mean, being down over 40+%, it is wild because, guys, the 52-week high on this company is more than double. It was more than double what they're currently trading at. This 52-week high on this company was $211 per share. So now trading at $103.25. We are talking Stanley, Black, and Decker, the dividend king position that Bert and his wife have been juicing up this year.
That's right. It's a sector that has been historically underrepresented in our portfolio. So we have been nibbling as the stock price has come down. We started buying at the 130s. Then guidance was cut. They dropped to the 120s. We started adding, lowering the cost basis. It continued falling down to the 110s. We continued lowering our cost basis. Now around the 100s. I can spoil the next video later on in the week, but we definitely lowered our cost basis a little more. We now own 18 shares of this company. all said and done. And we're probably going to be looking to buy because when you run this company through the dividend diplomats dividend stock screener, Lanny, metrics look pretty solid.
There's not many times where you could buy undervalued companies at these prices. And man, Stanley Black and Decker surely is showing some sheer value. Never seen them at these metrics, guys. So let's go through. Analysts are expecting $9.86 on that earnings per share right now. So when you do the math to calculate that first metric, the price to earnings ratio, you are calculating a 10.47 PE ratio, well below the S&P 500.
Yep, their annual dividend is $3.16. Divide that by the 986 EPS, that's a payout ratio of 32%.
Wow. So pretty much in line with what Citi is doing, except, Stanley Black and Decker increases their dividend every freaking year. So with a payout ratio of 32%, there's going to be no stopping this dividend train from going up.
Ain't no stopping me now. Okay. That's right. And that 5-year average dividend growth rate is 6.45%. So a little bit below inflation, not terribly trailing the current inflation, well above historical inflation if you take 2022 out of the picture.
No, I mean, again, it's a pretty good combo when we talk about the dividend yield, which for the bonus metric is now officially over 3% at 3.06%. So 54 years of growing their dividend at an average rate of almost 6.5% with the yield over 3%. That is a match made in heaven.
Yeah, so that's why they're on the watch list. In the previous videos, people have talked about their debt too. So we'll throw in a couple balance sheet metrics here for Stanley Black and Decker because we don't want to disregard that component of the company as well. Their debt to equity ratio is 1.3x and their current ratio is 0.9x, so just a hair below 1. So it's definitely something to keep an eye on with Stanley Black and Decker. You can't say they're not levered because they clearly are, but they still can almost cover their current short-term liabilities that are due in less than 12 months with their current assets.
Guys, and to summarize Stanley Black and Decker, you have a 10.47 price to earnings ratio, a 32% payout ratio, dividend growth for over 50 plus years, a dividend king, increasing at an average rate of 6.45% with the yield over 3%. Bert and his wife, you said you guys have 18 shares now?
Yeah. And you know what? I mean, honestly, the way this is looking, we'll probably at least get to 20 next week. Just keep adding 2 more over time. I mean, can build these positions slowly over time. I think that's really what the core of my watch list this time is. There are obviously plenty of other great dividend growth stocks out there that are undervalued. You can check out Lanny's recent watch list from what was it last week, Lanny? It's still applicable. And if not, it's even more of a discount than it was when we published that video. I'm sure everyone in the comments can add in at least 5 other stocks. These are 2 positions I've identified in our portfolio that are undervalued that we want to keep adding and keep growing to so that we can get to that full position where we don't have to think about buying anymore.
Guys, so there was 2 stocks right there, Citi and Stanley. Let us know if you're buying these 2 right now. Let us know if you've been buying the dip during this past week and if you're looking to buy after Juneteenth holiday here starting on Tuesday, June 21st. Bert, any other parting words?
Nope. Everyone, again, just keep buying, keep investing, keep growing that passive income. That is what it's all about.
That was Bert the Hurt and Laney from the Dividend Diplomats. Over and out.